I mean, in the capital stack, being able to go up in quality, right? And look, those balance sheets in the tech world are pristine, right? Plenty of cash on them. Credit quality is good. They just keep charging ahead, and they're using that cash wisely, I think. If you look at what we call shareholder yield, which is dividends plus share buybacks together, tech leads at about 5.5%. Right there with it is financials.
My book of the summer, book of the year, ages ago, you just heard it from Darrell Cronk, William Priest, shareholder yield. I'll get it out on Twitter and LinkedIn today. It is the Bible, and it's short. Paul, you could pop it off. You know, you could do the Vespa to the coffee shop and pop that off in 3 moments.
One train ride home. Talk to us about earnings. Darrell, you mentioned we're just kind of getting into the teeth of it right now. Yeah. What do we need to see? What does this market need to see in this earnings cycle? Because it's a lot of companies could probably fall back and say, listen, there's a war out there. We don't know what's going on with our business. What do you think what we need to see?
Well, you absolutely need to see, to be candid and direct, they don't care that much about this quarter and what's actually reported. We know it's going to be good, right? The quarter is going to be up 13% on Q1. Forward 12-month earnings are going to be up 17 to 18%, which is unheard of. This is the 6th straight quarter in a row we've had double-digit earnings growth, right? So it's all about forward guidance. It's all about what they say out into Q2 and Q3. That's what's going to separate the winners from the losers here as we go. And remember, we got big banks and financials. Between financials and tech, they're 46% of the market cap of the S&P. So they matter, right? What they do is going to drive where we go.
Darrell, towards the end of last year, we had a rotation out of some of those tech names, higher growth, higher value rotation, maybe a little bit of a broadening out, looking for some value, maybe small and mid-cap stocks. But boy, we've seen the tech stocks come ripping back here this month. How do you think about that allocation?
So we actually got a little lucky here, to be candid, Paul. So we downgraded tech on October 30th of last year. We just upgraded it again 2 weeks ago on April 6th. From that October 30th through April 6th, it basically effectively traded sideways, to your point, right? In the last 2 weeks, it's up 11%, right? And we funded it with energy, because at the moment when they did that trade on April 6th, oil was still at $105, $110 a barrel. Energy stocks were clear up. So energy is down about 6% since that time. So from a pairs trade, boy, positive tech minus energy has just been really accretive to the portfolio.
To what extent are you concerned about maybe some impacts on the economic growth, inflation, stemming from what might be higher for longer energy prices?
Yeah, I think look, the equity market to me is a reaction function right now, and it's a reaction function to oil prices, right? We see it every day, up, down, to Tom's earlier point, and then where interest rates go. I think interest rates are the most underappreciated thing here. The 10-year at 4.30, like at 4.30, needs to be higher, right? Remember the old rule of thumb that the 10-year should equal nominal GDP, right? I mean, the years, if you go back years ago, well, nominal GDP's easily got a 5 in front of it, right? I think the 10-year and the long side of the yield curve, because of inflation premiums, because of growth premiums, has to go higher. When it does, it causes some indigestion.
So I'm going to call that the Pozen-Orzag theory. They suggest, simplifying, that the way we will drive price down, yield up, is a surprising productivity and wage growth. Does Wells Fargo, can you be optimistic given our inflation that we're going to see a genuine positive real wage growth and a nominal wage growth that affects yields like that?
Yes. I mean, simple answer is we saw it already. Even the Iran, Israel-U.S. conflict hasn't dented that. We were going to run this economy hot coming into the beginning of March. And part of that was getting driven by wage growth.
Darrell Cronk with this Wells Fargo. I can't say enough about his underlying academics and trying to get a belief construct going on ownership of equity markets, and particularly those of you that are not participating, how to get courage. Okay, so let's go back to SV. You've got, dividend discount model. You got the Gordon growth model as well. And never talked about is the oddity of big tech residual income model. They don't have a dividend. There's nothing to count. Maybe there's some teensweens dividend growth. So you have to sum in all their cash flows and the oddities of it.
That's right.
How do you account? Let's take Microsoft just as the talking point. It's an earnings juggernaut.
Correct.
Do we price that in at a 21 multiple, Or is it just way, way more valuable than what we're saying right now?
The latter. It's way more valuable than what we see now, right? I mean, obviously, Microsoft's gotten dented with the software SaaS apocalypse thing. But when you look at them, yes, you're right. You got to value them on that free cash flow generation, and they're just a machine, along with a lot of the other tech companies. The reality is, to me, tech is a free lunch, and you don't get this in Wall Street very often. But if I'm paying a market multiple, 20 to 21 times, which is exact for tech today, which is exactly where the market is. The S&P is at 21 times, but I'm getting double the earnings growth. I'm getting 35% earnings growth versus 17% earnings growth. I'll take that all day long. Like, that's a free lunch, right? It's a free option basically on that. So the valuations I don't think are even remotely stretched here at 20, 21 times on tech when that's what I'm paying for the market.
Paul, one more quickly.
Bond market. What are we doing here in the bond market? Are we taking credit risk here?
No, you stay up on credit quality. I don't think you're getting compensated on spreads wide enough on high yield. It doesn't make sense here. I mean, if the economy runs hot, you'll be okay down the credit stack in high yield, but it's not going to be any big trade that's going to make you a lot of money.